Hey everybody, Jonathan Rose. Today we're going to be talking about vertical spreads in options trading. Let me ask you, do you trade vertical spreads? Do you trade debits or do you trade credits more often? In the comments, let me hear it. I want to know, do you trade vertical spreads and do you trade debits more or do you trade credits? And in this video, I'm going to explain exactly what vertical spreads are and the easiest way for you to calculate them. So let's go to an options chain. In front of you, I got good old Softy, Microsoft. It's a good one for a lesson. We're going to look at the Octobers. October 115s and October 120s. And to the right here, I just have an Excel spreadsheet. So we're going to be in October. We're going to look at the 115s and we're going to look at the 120s. The 115s are trading $1.90. $1.90. The 120s are trading 50 cents. Now we go to the put side. The 115s, let's say they're trading $3.10. The 120s are trading $6.70. Okay? So here's a vertical spread. Right now, Microsoft's trading at $113.52. The debit, if you wanted to buy this spread, you would buy the 115s and you would sell the 120s. If you did that for $1.90 buying and selling for 50 cents, that's going to be a debit of $1.90 minus $1.50 or $1.40. The most you can lose on this position, if you're doing a 10 lot, is going to be $1,400 of risk. The most that you can make is going to be the difference between the strikes. 120 minus 115 is 5. 5 minus $1.40 is going to be $3.60. So the most that you can make on this position is $3,600 and risk to do this debit spread. Now the seller, they're taking in $3,600 of credit. Their risk is going to be $1,400. Now the seller of this position is selling the $1.90s and buying the $1.50s. So for them, they're getting the credit of $1,400, but their risk is $3,600. Now let's look at the put side. The puts, the 115s for $3.10, the 120s for $6.70. What you'll notice is $6.70 minus $3.10 is going to be $3.60. See where we're going with this? $1.40 plus $3.60 is $5. $5 is also the difference between the two strikes. A question that professional traders always ask to try to see who understands options is this. If the 115, 120 vertical is trading for $1.40, what's the put vertical trading for? The way that you can do that is the difference between the strikes minus the call vertical. 5 minus $1.40 is $3.60. Or opposite, $3.60 plus $1.40 is 5. Calls and puts, they're the same exact thing. This shows their relationship. If you know the vertical of one side, you automatically know the vertical of the other side. If you know your risk in the vertical is $1.40 and the vertical is $5 wide, you know your risk is 5 minus $1.40. Easy peasy. Go over this video. Understand it. Pull up any options chain. It always works out. The only reason this wouldn't work out is if a stock is hard to borrow or if a dividend comes into play. But besides that, you could always go and figure out, hey, 125, 130, I could buy it for a nickel. If you do that, that's $50 of risk. The most that you can make is 5,000 minus $50, right? Just the difference between the strikes. You can do that with any strikes within the options chain. Any questions? Leave them in the comments below. I'll reply to each one of you. Thanks for watching, guys. Jonathan Rose, Active Day Trader.